The outlook for gold in this very volatile world has probably never been better. On the one hand, we've got gold production around the world declining. South Africa is at an 85-year low in terms of its gold production. Australian gold production is declining, and the United States gold production is declining, and China has become the world's largest gold producer. But the demand side for gold has been remarkably robust in 2008. It's very clear that physical gold has been sought out of every coin dealer and bullion dealer in the world, and people are very happy to pay premium of up to 5% over the current gold price to get hold of coins or small bar. Now, the futures market on COMEX for gold has been operating in a different world to the demand for physical gold, but the response this week of gold to go running over $800 an ounce again shows quite strongly that the physical market is catching up with the paper futures market, and I think it means that we're going to see an end to the manipulation that has taken place in the gold market over the past several years. Now, the gold price in real terms is still well below $450 in 1980 terms. And in 1980, the gold price got over $875 an ounce intraday on the 21st of January in 1980 in that bull market. So I think we're going to see gold prices in real terms well over 875 in 1980 terms, which would really mean that we'll be up around the $1,500 level, and I think we're probably going to see that sometime before the end of 2009. Now, in Australia, gold production, as I said, has been declining. Exploration has not been very robust over the past few years, even though gold prices in $8 are at record levels or near record levels of $1,150 to $1,300 an ounce. These are very high numbers compared to the numbers in 1980. What we've seen in Australia is exploration dollars have been raised, but the market has not been robust at all, and I think we're going to have to see a lot more exploration carried out in Australia and discoveries made to justify maintaining our gold production rates over 230 tonnes. Now, one of the most important things about the gold price is its relationship with the United States dollar. Quite clearly, with the amount of treasury bonds that will need to be sold in the year ahead, the American bond market must be looking quite fragile, even though it may be at 50-year lows in terms of yields on the long-dated bonds. Those things seem unsustainable to me, given an underlying inflation and the willingness of the Fed and other monetary authorities in the United States to increase money supply. That should result in a weaker dollar, and a weaker US dollar will mean a stronger gold price. Now, in Australia, we've got a universe of gold stocks which is only about 40 of producers or near producers, emerging producers, and that's much lower than what we've seen in previous gold booms. We've put together a matrix of gold producers, showing people that there are opportunities with the large cap stocks like Lihir and Newcrest, but there are many opportunities with the Dominions, the Integras, the Evocas that are producing gold at the moment, and these stocks are extremely cheap. Now, there are a number of explorers and near producers that also come up very well on our matrix. Now, one of the other things which is extremely important to understand right around the world at the moment, gold shares relative to the gold price in whatever currency you're talking about are remarkable discounts, and I think that in 2009 we're going to see those discounts removed, and we're going to see these stocks go to a premium. So have a look at our gold matrix on our website or in the report that's available, and I think you'll see that there's some excellent value. The gold market is extremely important to sentiment in Australia, and perhaps more so than many people think. And perhaps the best way of looking at this is to match the performance of the Australian dollar over the last 15 years against the Philadelphia Gold and Silver Index, or the XAU as it's known. Now, there's a remarkable correlation over this period between that Philadelphia Gold Index and the Australian dollar, which suggests that if the gold price moves higher, as I expect it to, the $A should recover much of the recent fall. I guess the alternative to that is that if the gold price is weak and gold stocks fall, and I can't imagine why they would do that, the Australian dollar would come down. But the overwhelming evidence in terms of supply and demand for gold, the chaotic position of much of the financial markets at the moment, and the very strong demand for physical gold suggests that gold prices are going higher, and therefore gold stocks will be going higher, and therefore the Australian dollar is most likely to match its performance of the past 15 years and move higher along with the gold price.